Have you ever wondered why your rent jumps, your groceries never go back down, and your credit card APR keeps creeping up even when the news says markets are calm? What if the answer isn't in Washington or on Wall Street, but in a round tower in Basel, Switzerland, a place most people have never heard of? What if there's a bank for central banks, with legal immunity and closed-door dinners, that quietly decides who gets dollar lifelines when the system chokes? No vote, no press conference, just a phone call. Welcome to the BIS, the Bank for International Settlements. We crack open its origin story and follow the money to the switch that still controls your financial oxygen. Quick check-in. Where are you watching from? Drop your city in the comments. And if you want the unfiltered truth about the money machine, hit subscribe right now. We're going to Basel, the birth of a neutral power, 1930s, 1930. The world is reeling from the 1929 crash. We need a neutral technical place to handle German reparations and stabilize finance. So they create the BIS under the Hague Agreements. Central bank of central banks. Neutral. Sounds safe. But here's what made the BIS different from day one. It wasn't elected. It was born by treaty. It had special protections. It became the clubhouse where central bank governors could speak off the record, away from parliaments and cameras. The story you're sold. It's just plumbing. Just coordination. But plumbing decides who gets water during a fire. And that's power. Central bankers began using Basel as the backroom where gold, currencies, and emergency measures get quietly coordinated. The two-tier truths, 1960s, 1971, 1961. The London gold pool forms. Central banks team up to hold gold at $35. Ooh, defend the dollar. Price pressure rises anyway. 1968. The pool cracks. A two-tier system appears, one price for official players, another for the public. Insiders get one reality, everyone else gets another. Sound familiar? 1971. Nixon closes the gold window. The dollar is no longer convertible to gold. Bretton Woods is dead. The world now runs on trust. Trust in central banks. Trust in the same network meeting in Basel. The rule writers move. In 1974 to 1988, Hersted bank failure causes global chaos. June 1974, the Basel Committee on Banking Supervision housed at the BIS. It will write global rules on capital and risk for decades. No referendum, no national vote. Just consensus among governors. 1988. Basel I introduces risk-weighted capital rules. Neat, clean, but incentive shift. Banks learn to game the weights. Sovereign bonds get favored. A paper gets a halo. Creativity explodes in offshore Eurodollar markets. Sound familiar? We'll handle it quietly. 199820007 Long-term capital management blows up. The Fed corrals Wall Street into a rescue. Bailout culture learns a lesson. If you're big enough and connected enough, the backroom will fix it. The idea of plumbing turns into a belief. The club will save its own. The unseen switch, the official myth, is that these are just technical fixes. But there's a deeper mechanism forming, something that creates invisible dollar OUs all over the world. And a switch that only the insiders can flip in a panic. Up next, we open that door and name the instrument that hides dollar debts in plain sight and the quiet pipeline that bails out the club. We're about to leave the history tour and walk into the engine room. The debt you cannot see is larger than the debt you can. You won't believe the number. If this is the first time you've heard of the BIS, type first time in the comments. Picking up right where we left off in part 1, the reason those quiet Basel dinners matter is because of a single piece of wiring under the floorboards that most people never see. When it fails, the fix doesn't come from a vote. It comes from a phone call. Back in 1962, central banks quietly stitched together reciprocal currency arrangements. Think of them as early swap lines, a way for central banks to exchange currencies with each other in a pinch. Over decades, that habit hardened into a network. Governors met, trusts formed, and the BIS hosted the rooms and routines. By the 2000s, the world was swimming in offshore dollars. Euro dollars parked in London, Zurich, Singapore, Tokyo, fueling trade. Commodities, corporate borrowing, and bank balance sheets. Why so many dollars outside America? Because the dollar is the world's oxygen. If you buy oil, ship goods, or invest abroad, you probably settle in dollars. But if you're based in Europe or Japan, you don't want to gamble your business on the exchange rate, so you hedge. And that's where the hidden machine starts humming. Meet the foreign exchange swap, the most important financial instrument you never think about. Simple version. You hand me euros today, I hand you dollars today. We agree to reverse the exchange in, say, 90 days at a set rate. On paper, It's a hedge. In reality, it behaves like a short-term dollar loan secured by your euros. Borrowing in disguise. Here is the magician's move. Accounting rules let this sit in the derivatives bucket, not in the debt line. The promise to return dollars in 30, 90, or 180 days is real, but it hides under a different label. Multiply that by thousands of banks, insurers, funds, and exporters rolling these positions over and over. And you've got a global treadmill of hidden dollar IOUs. In calm times, it's fine. Roll the swap. Roll again. Cheap, predictable, boring. Until stress hits, and then everybody runs to the same door. That's what happened in 2008. Mortgage securities melted down. Trust between banks evaporated. If you needed dollars and you were outside the US, your hedge suddenly got expensive. The cross-currency basis, the extra fee you pay to borrow dollars through swaps, blew out. Like surge pricing for oxygen. Rolling a 90-day swap became painful, then impossible. European and Japanese banks, stuffed with dollar assets, faced the cliff. Sell into a fire sale or find a new oxygen tank. That's when the phone tree kicked in. The Federal Reserve opened massive dollar swap lines with a select group of central banks. The European Central Bank, Bank of Japan, Bank of England, and Swiss National Bank tapped the lines and auctioned those dollars to their local banks. By December 2008, outstanding dollar swaps reached around $583 billion. Not a congressional vote, not a public debate. A network decision executed fast to keep the club breathing. The script got reused. During the Eurozone crisis in 2011, the lines reopened. By 2013, the core lines among the biggest central banks were made standing, always available. The message was crystal. Inside the network, the oxygen mask will drop automatically. Then came a strange tremor in September 2019. The US repo market, plumbing for short-term dollar funding, seized up. Overnight rates spiked to roughly 10%. The Fed rushed in with tens of billions per day, peaking above $100 billion daily to force rates back down. It was framed as a technical glitch. If you listen closely, it was the same theme. When the machine coughs, the insiders get the hose. And then 2020 hit like a brick. Borders slammed shut. Trade froze. The dollar index spiked. Suddenly, everyone who had been borrowing dollars via swaps needed to roll at once. The cost exploded. The same small circle moved in days, not weeks. Swap lines reopened. Usage neared about $449 billion. A brand new tool, the FEMA repo facility, let foreign central banks turn their US Treasuries into dollars on demand. Officially, this was about market functioning. Unofficially, it said, if you're in the club, we've got you. Look at the map and read the message. The Fed standing swap lines are with the ECB, Bank of Japan, Bank of England, Bank of Canada, and Swiss National Bank. In 2020, 9 others received temporary lines. Australia, Brazil, Mexico, Korea, Singapore, Sweden, Denmark, Norway, and New Zealand. Notice who's missing and what that implies. If you're not connected, you improvise, sell assets, burn foreign reserves, or let local borrowers fend for themselves. That isn't a free market. That's membership. So who actually decides? Formally, each central bank runs its own policy. Practically, coordination lives in relationships. It lives in the BIS meeting rooms, the Monday night dinners, the closed sessions of committees like the Markets Committee and the Committee on the Global Financial System. That's where dashboards are shared and responses are rehearsed. Not a public vote, just a call to someone you already trust. And here's the moral hazard creeping in. If the biggest banks and insurers expect the oxygen mask, they lean harder on short-term, off-balance sheet dollar funding. Why not? Profits are juicy in calm times. If stress hits, the network steps in. Parasitic finance grows in that shadow private gains on the way up, socialized costs in the rescue. If this still feels abstract, remember what you lived through. Markets fell off a cliff in March 2020 and then roared back. Dollars showed up where they were needed most for the institutions with access. The headlines focus on stimulus checks and shutdowns. Behind the scenes, swap lines and repo facilities were the real floodgates. Your grocery bill didn't spike because of a single policy. It spiked because the system decided to save itself first and explain later. Now, for the curveball we teed up at the end of part 1. The biggest dollar IOU in the system, IS&T on the balance sheets you see, is hidden inside those FX, swaps, and forwards. The BIS quietly tallied it in 2022. The number is bigger than the entire US Treasury market at the time. It has 13 zeros. Once you see it, you'll understand why every crisis gets bigger and every rescue gets faster. Ready to see the receipt in part 3? It's wilder than you think. And if you're still here, you'd be exactly the kind of sharp mind we want in this community. Stick with me for the finale. Picking up from that cliffhanger, The receipt is on the table. According to BIS research in 2022, the off-balance sheet dollar debt embedded in FX swaps and forwards is about $65 trillion. Yes, trillion. Larger than the entire US Treasury market at the time. Larger than the GDP of most of the planet combined. And most of it turns over in months, not years. That's the hidden treadmill. Institutions outside the US borrow dollars in disguise, roll those positions every 30, 90, or 180 days, and hope the music doesn't stop. It works right up until it doesn't. When stress hits, everyone tries to roll at the same time. The price to get dollars explodes. Suddenly, the invisible becomes painfully real. Anchor a few numbers so this isn't just theory. Peak usage of Federal Reserve swap lines hit roughly $583 billion in December 2008 and nearly $449 billion in 2020. Daily FX turnover worldwide runs around $7.5 trillion, 2022. And a huge fraction is swaps and forwards, the very instruments that create these hidden IOUs. Global debt, public and private, has blown past $300 trillion. And when the US repo market hiccuped in September 2019, overnight rates suddenly printed near 10%, forcing emergency injections exceeding $100 billion per day at peak. These aren't trivia facts. They're signposts that the oxygen system is stretched to its limits. Now make it personal. You're a German insurer with $10 billion in US investment-grade bonds. Your clients pay premiums in euros. You don't want currency risk, so you hedge. You deliver euros today, receive dollars via an FX swap, buy your bonds, and plan to swap back in 90 days. If the world stays calm, you just keep rolling. If panic hits, the cost to roll your dollar position jumps. Suddenly, your hedge is a margin call. You either sell bonds into a falling market, or you beg your central bank for dollar liquidity through auctions funded by the Fed as swap line. If that hose doesn't reach you, you dump assets. Prices fall, the stress spreads. Or you're a Japanese bank holding $50 billion of US Treasuries. Safe, right? But safety depends on the hedge. You've borrowed dollars via FX swaps to eliminate currency risk. When the cross-currency basis dives, meaning dollar funding through swaps, gets more expensive, the math breaks. You unwind. That is exactly what flashed in March 2020. The Bank of Japan tapped the swap line and funneled dollars to its system to stop the bleed. Closer to the real economy, a Korean exporter needs $500 million in dollars to pay US suppliers. It borrows in won at home, then uses an FX swap to get dollars. In March 2020, the swap market clogged. The Bank of Korea received a $60 billion temporary swap line to keep local dollar funding alive. Neighboring countries without lines had to burn their foreign reserves or ration dollar access to local firms. Same shock, different oxygen masks. This is why the map matters. The Fed's standing swap line partners are the ECB, Bank of Japan, Bank of England, Bank of Canada, and Swiss National Bank. In 2020, 9 more got temporary lines. Australia, Brazil, Mexico, Korea, Singapore, Sweden, Denmark, Norway, and New Zealand. If your central bank is on that list, the oxygen mask can drop quickly. If not, you're paying surge pricing in a panic or you're selling what you can. That isn't conspiracy. It's policy by invitation. Now shift from mechanics to meaning, because this is where the hidden costs land on your life. We're taught that debt is what shows up on the balance sheet. In reality, the most dangerous dollar debts hide in derivatives, not on a debt line. We're told every central bank is fully sovereign. In reality, in a crisis, policy is globalized through prearranged pipes and private trust nurtured in Basel. We're told markets discipline risk takers. In reality, when oxygen runs low, a handful of unelected officials choose which lungs get the mask. We're told bailouts are public and debated. In reality, the most powerful rescues flow through swap lines and repos with barely a headline. And the cost? You felt it. Inflation that sticks. Asset prices levitating on cheap money, then whipsawing when support is pulled. Savers punished with near zero rates while credit cards charge 19% plus APR. Home prices doubling over a decade on easy money, followed by rent spikes of 20 to 30% in just a couple of years. When insiders lever up on the assumption the hose will arrive. The bill shows up later in your budget, your job stability, your retirement timeline. You don't have to be blindsided next time. You can read the tells in plain sight. Watch the cross-currency basis for USD, JPY, and USD EUR. When it drops hard and negative, global dollar funding stress is back. Watch swap line usage on the Fed's weekly balance sheet. If outstanding swaps jump, the club is gasping for air. Watch BIS bulletins and central bank language phrases like market functioning. temporary facility, and FX swap usage are smoke signals. Watch repo rates. Sudden spikes like that 10% print in 2019 mean the pipes are clogged. Watch the dollar index during global shocks. A sharp surge often means the scramble for dollars has started. None of this is academic. The system is faster now. In 1930, money crossed borders by ship and telegraph. In 2008, it moved at fiber speed. In 2020, entire economies shut down in a week, and the dollar squeeze surfaced within days. With $65 trillion of hidden dollar IOUs rolling every few months, the next stress event doesn't need months to unfold. It can hit and spread in hours. The response will be bigger, the circle will be smaller, and the cost will land again on people who never had a say. Here's the plain spoken takeaway. We're reliving in a shadow dollar regime where the most consequential decisions ride on private trust and prearranged pipes. The treadmill won't stop on its own. The incentives are wrong. The moral hazard is baked in. Denial is expensive. If this helped you see the wiring behind the walls, share it with someone who still thinks swap lines are a conspiracy theory. Tell me where you were re-watching from and what you witnessed in 2008 or 2020 that you never want to relive. And if you want more unfiltered truth about the money machine, hit subscribe so you don't miss the next deep dive. Are we wiser now or just walking the same path in better suits?